advice do you have to homeowners?
Practicing that preparedness, starting the conversation now is always going to be a benefit to any association out there.
And welcome to Cover Report Live. I'm Dan Odess, president of GlobalPro, where we manage risk to recovery, and we have managed more than $1 billion in recovery. We represented thousands of community associations and business owners in the placement of insurance. And the Recovery Report Live is all about giving you information you can use, whether it's business strategy, recovering from a loss, or just preparing for disaster. We want to make sure that you, as policyholders, have the information you can use. And as we are in our 10th year, a decade of advocacy, we are continuing that charge, and the Recovery Report Live is just all a part of that. So I want to jump into something that just came across my desk this morning. It just hit me, and I'm going to get into the actual meat of what I wanted to talk about here today, which is condominium associations, how to buy insurance. There's been a lot of conversation about the rise in premiums, and we're having what I have coined as premium phobia right now. But before we get there, I want to talk a little bit about the reported insolvency of an insurance company here in the state of Florida. All right, so this article hits my email box. Of course, I jump on it, I start reading it, I start looking into it. And the article states, and I quote, "The insurance company is the latest in a line of insurers that have filed for insolvency in the face of Florida's catastrophic weather claims severity, a multitude of lawsuits, and get this, rampant fraud." Now, the title of the actual article itself talks about lawsuits and fraud. It only mentions two of the three that it then later notes as the reason or the root cause of the insolvency. But is it? So I want to break this down a little bit further by going to another article that, ironically, as you're reading this article, it links to, which was from yesterday. And this article states, and is titled, "Insurers Heading for Insolvency Amid Fraud in Litigation." But it makes no mention of any sort of fraud. Now, the other article, right, which was written by a veteran of a state's underwriting industry, states there are just other companies that are too thinly capitalized. All right, so we have two articles, right? One is titled "Insurers Heading for Insolvency Amid Fraud and Litigation." And we have a second article that is linked to inside this article about fraud and litigation that is causing this alleged insolvency of this insurance company, allegedly, right? And that article talks about thinly capitalized insurance companies, which is an interesting point, right? So in an article, Clickbait Today, that says that the insolvency is caused by this fraud and litigation, and makes very little mention, if any, about fraud or give any basis for the fraud. There's literally no basis for the fraud in the article. You can read it yourself. And interestingly enough, there's an article within there that you click to that talks about how they are thinly capitalized. Now, that brings me to a point I want to make, which is, as I'm reading through this, and I get to the point where it starts to allude to this alleged fraud that has caused the insolvency of this latest insurer, and it makes a comment about yard signs. It basically insinuates that the practice of asking your client, you the roofer, plumber, real estate agent, whatever it may be, you ask them and include in your contract that you're right to put a sign in their yard advertising your services, either a roofer or whatever else, is tantamount to a scheme of fraud using a yard sign. Seriously? Using a yard sign is an age-old practice by any industry, whether they actually put in a yard or the right-of-ways of our streets and avenues. But interestingly enough, that was the basis for some scheme or fraud that allegedly these roofers or that the industry is engaging in that is leading to the insolvency of this insurance company. But let's get back to the actual point made in the other article that is linked to in this article, which talks about the thinly capitalization, right? Because clearly the clickbait is unsupported, right? The clickbait being litigation issues and this idea of fraud leading to the insolvency, which seems to be the author's, attempt at trying to conjure up some anti-consumer support and legislation that they want to push through the legislative session that we expect here due to the governor's recent order, right? But the interesting thing, though, is if you investigate the solvency of these insurance companies, and one of the things that you will find common with most of them is the fact that they actually don't adhere to the reserve requirements, right? Or never make good on the promise that they make to the state as to money they will raise to pay for the losses for the amount of insurance that they're carrying or have sold. So they sell more insurance than they have reserves for, and then a major storm or something occurs, a major event occurs, a major disaster, which ironically is weaved into this article about the alleged fraud in litigation issues. They lightly touch on these issues of severity of hurricanes. And going back to the statement, it says that there's a line of insurers that have filed for insolvency in the face of Florida's catastrophic weather claims severity, right? So they tie it back to the severity of the weather claims, right? But it's usually those events which leads to the insolvency, which then brings me to my point, which is it an issue of someone using a yard sign, or is it an issue with the state not actually requiring the insurance companies to hold the proper amount of reserves? The article itself includes a link to this other article that explicitly states there are just other companies these are just other companies that are too thinly capitalized. And that, to me, speaks volumes. That, to me, is a root issue, right? The issue of reserves, the reserves to pay claims in the face of disaster, the ability to sell insurance that you have no money to pay for damages for, right? So you have nothing to back you. So that, to me, that's the root cause. That's the root issue. That is what should be tackled right here. And interestingly enough, in this legislation that unfortunately some of it failed, which should have gotten passed, which is about reporting practices from some of these insurance companies, may help cure some of that issue, right? So stop allowing insurance companies to sell policies of insurance on property for which they have no money to pay claims for, and then maybe we wouldn't be so concerned about ancillary issues that you have no foundation for and arguments you're making that really are not supported in any way by actual facts, such as yard signs and schemes. Yard signs and schemes, right? Yard signs being an age-old practice by most any industry to advertise and solicit business, right? I mean, at one point they were trying to make it impossible for a public adjuster to advertise any sort of services, even though it is your legal right to representation. And now we're hearing grumblings of insurance companies getting ISO forms, insurance company forms approved that in exchange for a reduction in your premium, a very, very small reduction in premium, you're willing to go it alone, to not have representation, meaning that you are at their mercy, that you are not willing to sue them if they don't do what they're supposed to do. You waive your rights to that. You waive your rights to representation. You waive your rights to knowing what you're entitled to recover for under your contract. Think about that. And here we have this clickbait article about litigation practices and fraud, even though in the article itself, there's very little, if any, actual basis for these opinions, other than a catchy article that, again, caught my attention. And interestingly enough, though, as you're reading through it, if you're paying close enough attention, it clicks back to, it refers to another article that actually talks about what to me is the root cause here. Insurance companies not actually having reserves to actually pay claims. That's the problem, right? That is the real problem here that we're having with most of these insurance companies. Another issue we're having is brokers and agents peddling this idea that by hiring representation, whether it's a public adjuster or attorney, that it's going to lead to increased cost of insurance or non-renewals. Again, not supported. In fact, in several instances, we've seen where community associations have received copies of the declaration recently signed by the governor in Florida, demanding a special session on insurance. And in it, the governor himself cites two issues in homeowners insurance. Nothing to do with the commercial policy sold to community associations, but it's being used by brokers that are selling commercial insurance to discourage community associations from seeking representation in their claims. I can't make this stuff up. None of this is really making any sense. We all understand they want more profit. Okay, just come out and say it. Don't try to make everyone the enemy here. You didn't have enough money on hand to do these things. The issues in the homeowners market has very little, if anything, to do with the commercial lines market, which is mostly in the surplus lines market anyways already. That's the fear on the homeowners insurance side, is that it go into the surplus lines market, it's more expensive and everything else. We're already largely in the surplus lines market on the commercial side of it. But however, the declaration signed by the governor, it makes no mention of commercial insurance policies or any issues with it. It talks about homeowners insurance. It does not talk about commercial policies. So let's dispel with all this nonsense, this bullshit, and let's focus on the real issue here. Let's talk about the solvency issues as it relates to reserves for disasters in the state of Florida. But on that note, let's talk about a real important topic for community associations: how to buy insurance, right? And I'm going to go down through a couple different things. We're going to hit on appraisals. We're going to hit on premiums. We're going to hit on loss runs, right? We're going to hit on deductibles. And we're going to hit on hidden exclusions and limitations and new endorsements in your policies that are all impacting your insurance. The rating that you get, the types of recoveries you can get, and what your broker is doing or saying to you that may not be correct, or maybe loosely based on misinformation that they are using to leverage you into purchasing some other policy that may not be in the best interest of your association, and quite frankly, may not even comply with your obligations under the statutes in your state, particularly in Florida, 718, 711. There are certain obligations of an association. There's certain requirements of you and the types of insurance you should be buying. So let's hit on appraisals, right? And we're going to make sure that you get this list of these important issues so that you can kind of follow through and guide you through the process, whether you bought insurance or going to buy insurance in your process of doing it. These are important things to look back at or to look at while you're in that process or thereafter to see whether or not you got what you should have gotten in it, right? So first thing was that I'll say regarding appraisals. Let's hit on appraisals. For appraisals, check them closely. It's really, really important that you check those appraisals closely. Don't assume that they're right. So if a new one has been ordered, really check it closely. There's been a lot of ancillary things that I've noticed when these appraisers are using a lot of template forms. They're going from one property to another, and they're getting a lot of these requests lately because of the extreme rise in construction costs, or sometimes another unfortunate mistake. A lot of community associations are focusing on real estate values. It's like, oh, our real estate values are going up so high that we need a new appraisal. It's not the real estate values that you should be focused on. It's the cost to restore your property following any major disaster. That's the cost of the construction. That's what you should be focused in on. Remember, the insurance doesn't cover you for everything, right? It's not the foundations. There's certain limitation exclusion of ancillary buildings such as cabanas or pools or fences. Those things most often are either limited in coverage or excluded from your policy. So it's not the real estate value that you should be really focused on. It should actually the construction cost. So you need to look very closely. And notice one thing about these appraisals, right? These appraisals are mostly based on Marshall Swift evaluation. Appraisals done based on Marshall Swift. It's not the value which you would typically get paid back in your insurance claim. In fact, in over 10 years of doing this, I've never seen a claim valued based on Marshall Swift on any commercial policy that I've ever handled a claim for. That's thousands of insurance claims, right? $1 billion in recovery here at GlobalPro. I've been doing this a lot longer than even GlobalPro has been around in existence. And I can tell you right now, I've never seen an insurance company value a claim in the same way in which they actually sell you insurance at that same rate. What we have found is typically the Marshall Swift valuations when appraisals are higher than the RS means or other databases that are being used for construction costs or built into the estimating software on claims, which is a whole nother issue. I've mentioned it before, but it's definitely something you want to take a look at. Now, that's often we see that when looking on a unit cost basis, on a material or labor line item by line item, right? It's a very deep analysis, and it's not something you can just give a broad stroke to. A lot of appraisals, though, do broad stroke things And quite frankly, that's not wrong in practice. However, it's very different than how you get paid in your claim. So you need to understand that, but look at it very closely and do a deeper analysis of, again, focusing on construction costs. What is it going to cost you to restore this property? That's really where you need to have your focus. If your association has several associations within, let's say, a masters, or there's several different towers and they're bifurcated. You have the south tower, the north tower, or the east and west tower, or towers 1,000, 2,000, 3,000, whatever it may be, and you share in common area elements. It's very important that, particularly if you're using different brokers for each of the towers, that all of those brokers are aware of what your insurable interests are and where they begin and end. I can't tell you how many times we have seen where the same broker representing several associations and a masters has duplicated insurance, and there's an overlap in coverage. The benefit of that is to the broker, right? They get paid based on a percentage of what they write you, what they sell you. So the more insurance they sell overall, the more money they're going to make. Now, if this has occurred over the last several years, you can go back and ask for rebates. So if you do have an association that's made up of several different associations and a master, or maybe not a master's, but you're sharing in common elements with another association or a hotel operator, whatever it may be, look at that. First, look at your bylaws, consult with counsel to delineate where your insurable interests begin or end, and then look to the appraisal to make sure that the appraisal accounts for only those items. And then look at your insurance to make sure that they've accounted for what's only in that appraisal that is correctly defining and delineating what your insurable interests are. So very, very important thing. We see some of the biggest mistakes with glass policies for some reason. I don't know why, particularly where you have a master association, and then several other entities, whether they're other community associations under it, or a hotel operator, restaurant operator, wherever it may be. Within the common area, maybe even have a gym operator in there. It's really important to understand where their insurable interests begin or end, looking at lease agreements, looking at operating agreements, looking at the Master Association bylaws, and looking at your community association bylaws. Again, strict coordination. For some reason on the glass policies, we typically see a lot of overlap between, let's say, a hotel operator and a condo association that are sharing the elements, and the condo association has access to and use of the hotel amenities. You sometimes see on the glass policies there's a tremendous overlap, and we've corrected that for associations in the past. It's definitely something the insurance experts here at GlobalPro can help you with. So if there's been and another thing is, if there's been a dramatic increase year over year in the insurable value of your association property, the property that's covered property under a policy, look really closely at it. This is something you can go back to, ask the appraiser. It may be correct, but definitely do your own research. Look at these things closely. Ask your neighbor. I've been encouraging associations lately to start to work together with regards to insurance. Who are they getting insurance from? What are they getting? What's the rating they're getting charged for these things? What are they paying their broker? How are they paying their broker? What types of coverages are they getting? What limitations, exclusion? Be a good neighbor. Go knock on the door next door. Maybe they're even managed by the same company. Maybe even easier to get that information. But working together, I think, is probably one of the best things we can be doing right now for our community, amidst a lot of this misinformation out there and the issues that are going on at a legislative level, insolvency, and the agendas by a lot of these insurance companies to continue to jack up our rates and to strip the policies of coverages. We need to start working together as a community, looking for ourselves, because these big corporations are certainly looking to pad their bottom line, and it goes into a lot of big nuances. So definitely check those things. And the last bit on the appraisal is, because this is a guiding principle for the actual premiums and the policy themselves, making sure that the locations are accurately listed. So within the covered property for your association will be a list of different locations. If you have cabanas, you have pools, you have other structures, maybe there's several towers, making sure that they're all included in there and properly listed, and the values are properly assigned to each of those. We sometimes see, there's just Scrivener's issue or a Scrivener error made by the appraiser where they misallocate dollar values or incorrectly assign them. So and I go back to the appraisal because the appraisal is a really important thing. We're seeing a lot of new appraisals being done right now. It's definitely something a lot of brokers are calling for amidst the tremendous rise in increased cost of construction. Material shortages are leading to higher demand than usual and higher prices. So definitely, I think it's actually a good thing to do every so often to update these appraisals, particularly when you're seeing tremendous increased costs. We've talked about it in prior episodes, 17.5% year over year. Like, these are definitely things you want to account for, make sure that you're properly insured, but it does increase your cost of your insurance. And when your properties are being stripped of coverages, you really want to make sure that these are accurate. So let's talk about premiums. Let's move to the second bit of this, right? So how are you buying insurance? Well, we're always really sensitive with regards to price when we're in a nonprofit for a community association. Premiums, unfortunately, most often we're just concerned and we're focused on getting them down, right? We want them to be cheaper. But there's a lot that goes into calculating your premium. And many community association boards are, and particularly managers, are completely unaware of how they get calculated and probably never even asked for a broker to explain how to break down the cost of their insurance. But when you got an invoice from a contractor or your professional service people like a lawyer, you most often, when you received it, went through the hourlies, went through the line items, and made sure that it was accurate and correct. Unfortunately, on insurance, a lot of times we just assume that the broker just did what was in your best interest, and you kind of move on. Start to get a little bit wiser about it. Start to require that your broker demonstrate their knowledge of the cost of the product in which they're selling you. If you went to go buy a car, you look at the actual window sticker and you want to know what options are on there. Why aren't you asking for the same? And a lot of times when you look at those options on that window sticker for the car, it'll break down the costs associated with each of those options. And it's meaningful to your decision as to whether or not you're going to buy or pass, right? Well, that should be the same thing here. You should break down the coverages and the costs associated with those and the ratings that are being given to them so that you fully understand how they're calculating what you owe them for that product. And if there's any issues or discrepancies in it, that you can go back to them and get it cleared up. And I can tell you that I have found errors in the calculations of premiums. The ratings change from one coverage to the next, and it shouldn't. Again, going back to the appraisal, we identify an issue in the appraisal which is leading to an error in the calculation of premiums. So look really close at that. Also, pay particular close attention to your broker's commission in the calculation of premium. How is it being paid? At what rate? Again, higher prices stripped of coverage. If you're selling me a lesser product at more money, if I'm getting less product, why am I continuing to pay you more and more commission? You would never do that for any other type of product out there. If you got less, if I got less slices of bread, I would expect to pay less than the one that has a dozen slices. I would expect to pay more for the one that has a dozen slices than the one that has 6 slices, right? Stop paying for the dozen slices even though you're getting 6. All right, it's a terrible analogy, but just to illustrate my point, stop overpaying for the services of someone that's selling you less product. They're selling you less product. You should be paying less commission for it, and it goes to the calculation of your premium. It's just a fact of the matter. It's just a fact. I have nothing against brokers agents making money, but if they're going to sell less product, then they should get less commission. And if they can get you more product, then they should work for you and get more product. And if they can get the insurance company to sell you more product, then they should get paid for that more product. But that's it. So if they want to exclude water coverages or jack your deductibles up on water claims, well, quite frankly, then they should get less commission for selling you a product that doesn't cover water losses anymore, or pays you less for one of the most commonly occurring losses in a community association. It makes sense to me. I can't even see how a broker would argue against that. It doesn't make any sense for you to continue to pay more for less coverage. So just look at that closely. Typically you'll see a list of coverages or locations listing and adding up those things. Also, again, making sure that math is done properly will go to it. So again, going back to that issue of locations, making sure they're listed and how that gets calculated in there. Premium financing, a really low cost way to spread the cost of your premiums out over a 12-month period. If you're unaware of this, which I think most community associations are already in tune to this, But if you're not doing this, it's definitely a way to spread out the cost of it, particularly when you haven't reserved enough or budgeted enough for the increases that you're seeing in your premiums. Spread it out over the period of time or the insurance is in place, and see what attractive rates. And I will tell you that there's very little negotiation in it. The cost of it is usually pretty low on an annualized basis. There's not really a lot of room to negotiate on the cost of the financing. But definitely look at it, and if there is, there is. It doesn't hurt to ask. Get a little savvy when it comes to this. Loss runs, all right? So loss runs, treat them like your association's credit report. Unlike credit report, it should not largely impact your ability to transact property insurance. It may impact your ability to transact general liability, E&O insurance, things like that. Obviously, rampant claims being made against the association and the actions of your board are certainly going to take into consideration. But as it relates to property insurance claims, I've said it many of times, I have yet to see anyone prove to me on the commercial policy side for community association how it directly impacts ratings and rates. I haven't seen it. I haven't seen evidence of it. I've seen the actual opposite of it, where we've recovered tens of millions of dollars for an association. They go to a renewal and they got a rate reduction from the same insurance company that just paid them that money. Because the fastest way for an insurance company to recoup its money they paid or losses from paying a claim is to reinsure you, is to insure you again, is to continue to renew you. So it just kind of flies in the face of it. Also, if you recover money for a claim and you repair a building, and the building is, let's say, 10 or 20 years old, mostly what you're going to put back there are better materials, better quality materials, better installations. Sometimes you have increased costs of construction insurance. So you're going to get code upgrade stuff. You're going to get an upgraded building, a better property, a better secured property, one that's going to, theoretically be exposed to less risk, be more fortified against storms if you replace windows. So it begs the question as to why we continue to peddle this idea that claims with regards to property insurance or hurricane coverage impact claims. But again, though, it's important that there's not erroneous information on there in any regard. And sometimes we see that we call up our friendly agent or broker, we inquire about particular coverage for something because for some reason we think that they're knowledgeable of claims and may even have access to our insurance policy, but most often we find that's not true. But let's say you call them and you just inquire about it. Say, hey, we had a small incident and it occurred in 2 units. We're not sure if we should make a claim or not. What do you think? A lot of times I see brokers put that or file that on the loss runs, even though you're not going to pursue the claim, and then assign erroneous values to it. They say it's going to be $25,000 or $50,000 because you say to them, oh, if it's not going to exceed $50,000 deductible for water claims, then I'm not going to pursue it. And then your broker goes on there and puts and assigns a reserve to that claim for $50,000. Even though once you got done mitigating and repairing the property, the claim ended up only being about $3,000. Well, go back and correct that information. You don't want erroneous information on your loss runs. Maybe you didn't pursue the claim at all. Maybe there was no claim there to begin with. Maybe it was just a routine maintenance issue after further investigation. Well, then why is it there? Don't allow those things to exist on your loss runs. Make sure they're corrected. Go back and look at those things to make sure that they're not there and that they're doing stuff. So don't fear the claims, but make sure when you're making the claims that the intention is that there's a meaningful recovery. We want meaningful recoveries. So GlobalPro, when I founded the business, a lot of the marketing advertising stated on it the name of the company, GlobalPro Recovery. It wasn't GlobalPro Claims. Why? Because we're here to help our clients recover from loss. Okay? We're not in the claims business. We don't want to just make claims for the purpose of making a claim. That doesn't do anyone any service. It doesn't do you any good service. It doesn't do the insurance company. It certainly doesn't help us either helping you. So make sure that you have that there's a meaningful recovery. But how do you know there's going to be a meaningful recovery if you don't have someone representing your interests, right? And the insurance companies are working really hard at the legislative level and we're in various different states throughout the country to strip you of the right to representation, either by capping fees, reducing incentives to those that pursue these claims on your behalf, or illegally making it illegal for a public adjuster to operate or provide services to a policyholder. They would rather see you unrepresented, unknowledgeable, at their mercy than having the information you need in order to properly adjust your claim and to recover from your loss. It's absolutely, utterly remarkable. Now, as I get a lot of questions about, loss runs, how far back? 3 to 5 years. I would definitely make sure that when you're placing insurance or going through a renewal, that you do have a copy of your loss runs and you have reviewed them. They're not just for your broker. Make sure that you have a copy of those as well. So when they peddle this information about, your claims and your losses and everything else, make sure you're fully aware of what your actual claims are. I can't tell you how many times when I go to the broker who sent an email to the association saying, oh, your rates went up because of your loss history, and then I asked that broker for a copy of the loss runs 3 to 5 years. They don't even have a copy of them, or they only have like 1 year. They have the prior year, and that's it. Well, I mean, that's really not a good indication of the history of the property and what they may think is contributing to the rise of your cost of your actual insurance, all right? And something really, really important as it relates to loss runs is if reserves have been set on a claim, right, which is typically the amount an insurer thinks they will owe for a claim, it may be on your loss run. But the amount that they paid out in a claim, kind of similar to the broker erroneously assigning a value to the claim, well, you might have actually gone through the reporting process and noticed the insurance company a claim, and then the insurance company themselves may have erroneously assigned a reserve to that claim, but paid substantially less than it. Again, let's make sure that we make sure that there's facts and accurate information on there so that information isn't somehow used against you, whether it's actually true and accurate or not. So really, really important. Deductibles, over the years, we've dealt with deductible phobia, particularly after the 2017 storm season in the South Florida market as well as Texas. A lot of people were like, I don't want to file a claim because my deductible is so high, I'm not going to get any money anyways, and then they're going to raise my rates because of my deductible. I think we've dispelled with this idea of deductible phobia. Important concept to understand is this idea of a cumulative deductible during a policy year. And if your association has these types of deductibles that accumulate during the policy year for hurricane, windstorm, or named storm policies, depending on how they label that actual policy that covers you for these types of damages, that you understand what that means and how it will be used in determining whether or not you have a net payment owed to you. If you don't have that type of that deductible in it, I definitely recommend that you go back to your broker or agent and ask about it, because as we're seeing associations shift from 2 to 3 to 5% deductibles for named windstorm or hurricane type losses and their policies, it's really going to become meaningful because those deductibles are in the 7 to 8 figure range. That's tremendous. And it's really important that you are properly reserving for that. But it's also important that you understand whether or not you need to report every little bit of damage that occurs from every possible storm that may be associated with that type of policy or coverage. And there is a difference between a wind policy, windstorm policy, a hurricane, or a named windstorm policy. There's different types of forms that are available to these insurance companies, particularly surplus lines. Some of them will account for an actual named storm. Some of them will account for a wind speed that will fall within that category. So it's really important to understand what constitutes a type of loss or claim that may be included, or those damages may be included in the valuation on a cumulative basis, and determining whether or not you're owed a net payment. So really look closely at those things, right? So moving to my last bit here on hidden exclusions, limitations, and new endorsements, right? It's really troubling times that we're in. We actually were looking at a policy just yesterday. The concept of wind-driven rain has found its way into the body of the policies and is no longer always an endorsement and easily identifiable. For this association, they were completely unaware that if there was a failure in the facade or the exterior of the property and water got into it, that whether it was caused by a covered cause of loss or not, they would at all times be limited to only $10,000 in coverage, whether wind-driven or not, or hurricane-related, whatever it may be. It was a very broad limitation, and the association was entirely unaware of it. In fact, we went back and looked at a couple policy periods before that, And several years ago, it was called out in an endorsement. It was a separate endorsement. The broker did not advise this association that this new endorsement was weaved into the policy itself and capped at $10,000. And they did have a issue of failure in the roof system and interior damages, and the insurance company immediately took a position. We only owe you $10,000. We don't think any of the damages are covered anyways, but we're going to go ahead and tender the limit of 10 grand to you. It was a shock to that association. They've consulted with legal counsel. They've consulted with us. They're looking for any way to deal with this, and it's an unfortunate situation. So it's really important that you look for these hidden exclusions and limitations, and these endorsements that once were called out were very easily identifiable are now being weaved into policies, like this idea of getting a rate reduction to waive your right to representation and to agree to arbitration rather than litigation. In the state of Florida, particularly, as well as other states, you may be entitled to attorney's fees and a bad faith interest on money, et cetera, if you had to sue your insurance company if they did something wrong, like didn't pay your claim even though it's covered. Well, you waive your rights to all of that for a marginal reduction in your premium costs. It's total garbage. There's some insurance companies out there offering this right to repair. Again, if you look at the reduction that they're giving you in exchange for these types of the waivers or services, they pale in comparison to each other. They don't add up. They're not very meaningful at the end of the day. So whatever pennies you save today will cost you dollars later on. Don't get caught up in that situation. And so this concept of wind-driven rain, where rain driven by wind from a hurricane was suddenly not hurricane damage, right? We're all accustomed to this now, particularly for community associations that suffer damages sometime after the 2017 storm season. Again, something very important to look for, because when you're reserving, you're not only reserving for deductibles, now you need to reserve for these exclusions and limitations. So if your broker or agent's not calling these things out and identifying these things in the product that they're selling you, then you're unaware that you need to have money on hand to pay for these things. And there are policies I'm seeing that, while they do afford you coverage for wind-driven rain, even if it's from a hurricane, they put a cap on it of about $100,000. And then you have a 5% deductible on top of that for hurricane damages. It's convoluted, it's confusing, some people lawyers may even say the word illusory, ambiguous. There's all kinds of catchphrases and things you could say about it. It is what it is. It's in there. Unfortunately, it's very anti-consumer. It's very complicated and confusing. And the insurance experts at GlobalPro are ready to take your calls and answer any questions you might have at it. And more associations today than ever before are hiring us to actually help them place insurance. It's certainly something we do a lot here. So it's really important that you understand this concept of this idea of, and I'm going to use a heavy word here. It's an insurance term, right? Proximate cause. We're seeing where, like, one of the age-old issues we've seen is water and mold, right? A lot of people see the mold first, but don't realize that it's actually the water damages that they should be most concerned with, because it's the water damage that led to the mold. So much like like fire and soot, right? You have the water, the source of moisture, and then the mold. But the mold is more dramatic. It's exciting sometimes. Unfortunately, in today's day and age, people kind of operate in the negative or become alarmists over things too soon, and don't want facts and information. They just want to make a point. And I think that sometimes this issue of proximate causes is kind of built in there and mixed up into all these complicated issues. And the soot is a proximate cause. The cover cause of loss would be the fire, right? Mold is somewhat similar, but they've gone ahead and put a supplement on it, just like with wind-driven rain from a hurricane. They've gone and put a limit on that stuff. So they're getting more complicated, and you're having to reserve for these things a little bit differently and think about it a little different. So just bringing you back the conversation, if you have issues with these things, your brokers are there to sell insurance. They don't adjust claims no matter what they say to you or however they may have said it to you. They're not your enemy. They're not our enemy. But you understand that what role they play in this process is really important to making sure that your interests are protected. So we want to make sure you have all the information you can use. And that's what this is always all about here at GlobalPro. Many people in the industry are our friends that sit across the table, that represent insurance companies, that help and sell insurance to you. Unfortunately, they may not have access to the right information, or they may be providing information that may not entirely based on facts. It may be part of an agenda, or it may be someone trying to accomplish some sort of goal that they set out to. It may not be into your interest though, and it may convolute your situation or mix it up into that situation. It may not represent your issue entirely. So you want to make sure that you're getting information from those that are representing you. You want to make sure that you're paying for you make sure what you're paying for, that you understand what you're buying, okay? And start to ask a little bit more questions about that. But I know this is a little bit of a longer segment. I know I've been sitting here talking a lot about a lot of issues, but these things are coming at us every single day, and it's a really important episode. I wanted to break down all this for community associations. I went in depth on these issues for a reason. I'm hearing this stuff more so now than ever before, and I think there's some confusion in the marketplace led by some agendas at the legislative level that may not be in all of our best interests, particularly for community associations, business owners. So if there's anything that we can do here at GlobalPro to help you navigate this process, let us know. So if you want to continue to get this information you can use, make sure you like us, follow us on all the social media. We are here every single week, right in the Griffin studio, broadcasting the Recovery Report live at 11 o'clock Eastern Standard Time. And if you haven't already, hit the subscribe button and follow us on all the social media. We want to make sure that you have information you can use. So again, thank you so much for joining me this week. We will see you same place, same time next week, right here on the Recovery Report Live.